Hello and welcome to Commodity Champions. I'm Manisha Gupta. A price cap at $60 per barrel set by the G7 as well as an outright ban by the European Union on Russian seaborne oil. All this came into effect this week as the two blocs try to reduce the Kremlin's ability to continue financing the Ukraine war. The EU's oil embargo also applies to European Union operators that insure and finance ships carrying Russian crude oil around the world. But it does not apply to Russian oil imports coming into the bloc through the pipelines. About 10% of oil imports coming in from the Druzhba pipeline will continue temporarily. However, S&P Global expects to see a significant rise in demand if China eases COVID restrictions going forward.
The threat the Russians have, and at least they've threatened it, is to hold back on oil supplies and make the market tighter. So we're in a very uncertain and indeed turbulent waters. If we do have a global recession, but right now what we see is the oil market, can you imagine that it responds to every piece of news about COVID lockdowns in China? And if those lockdowns are lifted, you're going to bring some significant demand into the market that has now been sitting on the sidelines.
Oh, well, absolutely. As Dan Jurgen says that every small bit of news that comes in from China or the global markets has been impacting crude oil prices. And every week in this year, we have seen the crude prices trade within that range of $10 to $12 per barrel. I mean, this is the highest in decades as we see. But what's the sense going forward now? This clearly is nearing the end of year as well. Joining me now to take the discussion forward is Sushant Gupta. He's director at Mackenzie. There has been a lot happening, Sushant, in terms of crude oil in the last week. But I want to start by 2022 as well, because there has been a war, recession fears, hike in interest rates, now more sanctions coming in for Russia. How would you summarize it all?
Well, it has been, first of all, thanks, Manisha, for having us here. In terms of summarizing the year, the only word which comes to mind is volatility. I mean, we have seen extreme volatility in the first quarter of this year, after the Russia-Ukraine war, where prices, breached $130 a barrel. And, not just in the absolute term, but also in terms of daily averages, we were seeing movements of $10 to $15 a barrel, very normal. Now, so the most of the time, the market was thinking of that as a fear of supply from Russia, which over a period of time, even after putting the sanctions, we did not see Russian exports coming down. So they were very resilient, and Russia was able to find alternative markets into China, India, Turkey. So, once those fears are gone away or reduced in the market, we see some of the demand aspects coming in the forefront, where the weaker economic growth, particularly in the OECD economies, US, Europe, and also linked to China's COVID restrictions coming to the forefront. And that's what we are seeing today. The oil prices are reacting to a weaker economic outlook and the zero COVID policy impacts in China.
Oh, well, absolutely. So much to look back to and so much to look forward to as well. Joining us on the show also is Paul Hickin. He's director at S&P Global Platts. He joins us from London. Paul, hi, good to have you. So much has happened in this week, whether it's about the OPEC meeting or the G7 price cap and, of course, the European Union embargo as well. What do you think will impact the crude prices and demand the most going forward?
I think the gentleman before said it right, which is volatility. But what you've got to think about is why there's so much volatility. And that is because two factors, really. One is because the things that are causing that volatility are huge. Like you mentioned, China. Everyone was talking about China demand coming back. China demand coming back. We've been talking about it all year, and it hasn't come back. But it's a huge consumer of commodities and oil. And everyone is still waiting for that against the backdrop of a global recession where demand generally is weak. And that is going to be a big narrative in 2023. I know we've all talked about sanctions, and it's a big marker, but demand is still a real driver for 2023. And then you look at the supply side, and that is also a big factors. Everyone is kind of trying to put their estimates down around how much supply loss the sanctions and the price cap will have. a lot of the estimates were around 2 million barrels a day early on for the next 3 months, but that's come down. I mean, S&P Global Commodity Insights sees more like 1 million barrels a day in the next 3 months, and that's a testament to the resilience of Russia to be able to find buyers. India, China, Turkey being key, but also the fact that the questions over the price cap and how much it will really impact, given that the Urals export grade, Russian Urals export grade is trading at $53 a barrel, roughly, which is below that price cap. And I know there's the mechanism in place to try and adjust for that, but still, you've got to question whether the market is really going to balk at those prices and continue buying a lot of that Russian crude. So they're the key factors that the market's looking at going forward.
Paul, a very valid point that you made, and even as the mechanism says that the price cap will be 5% below the running price, and running price, as you said, is $53, and the price cap comes at $60 a barrel, and it's going to be 2 months before that is adjusted. How does that even work then?
Well, this is the issue, which is actually how the enforcement mechanisms that are going to become in place, what the penalties. We've already seen around insurance. The EU backed off a little bit about the penalties around insurance and about the ships transferring some of this crude and the punishments in place. Now that's been softened. So the question is now the market are thinking about what are the workarounds. We've seen with Iran and Venezuela how they've worked around a lot of the sanctions, how we've seen a lot of buyers of undisclosed vessels over the past year, a spike in that. So there's clearly the market's already looking at, if you get the price go low enough, there's often buyers can be found, and that's going to be the issue going forward. Trying to enforce those sanctions and keeping the price cap and trying to make some impact when Russia will probably, which is actually going under the radar a little bit. The fact is, if the sanctions do work, what impact does that have on price? And that's likely to impact consumer countries. So it's kind of an oxymoron for that price cap if the sanctions start to work.
Oh, well, yes. Sushant, this one is to you. So while the G7 price cap at $60 per barrel is higher than where the Russian Urals are right now, it by itself hasn't really evoked a lot of reaction or emotions into the market. What's your sense, and what is the street waiting for?
Well, I think it's the G7 price cap should not be looked on its own. It has to be looked together with the EU ban on Russian crude oil. So we expect the G7 price cap on its own will have limited impact because 80% of the Russian crude oil, is expected to move towards Asia, China, and India particularly, and both these countries have not subscribed to the price cap. What we see is, in the next few months, as the logistical challenge comes to the forefront, where we see a huge amount of Russian crude needs to find an alternative markets into Asia. They need to move this crude in the longer haul distance on smaller ships, which will require a much larger number of ships to carry the trade, and that becomes a key bottleneck while it all settles down. And plus, the G7 price cap prohibits the companies from handling Russian crude above the price cap, more from the shipping and the insurance perspective, and that makes it a bit more challenging for this trade to happen. So we expect Russia's production to come down in the near term by up to 1 million barrels per day, now, which could tighten the market in the next few months and support the prices towards higher levels than what we are seeing today.
Clearly. Paul, this one is to you. And, the whole market is expecting Russia to retaliate in some sense. And whether it's going to be on crude front, whether it's going to be via metals to many of these countries. What's your sense? What case scenario are you working with?
I think Russia in generally has not used oil as a political weapon. It's a huge revenue stream. But at the same time, like I said, it could be the situation where the sanctions do start to work, and that potentially plays into Russia's hands because the prices go up and they get more money for their crude that they do sell to a lot of the world, and to India and China, who are going to take more crude, more like they've got some capacity to take extra barrels. So it could backfire in that sense. So there's a lot of uncertainty, and that is why the market's still waiting to see what sort of reactions Russia's going to have, what sort of reaction, how hard are the G7 going to go in terms of trying to enforce this. So these are the real uncertainties, and you can see that the way OPEC Plus decided to hold fire on any extra production cuts or any change in policy. Their mantra was very much wait and see, because again, they didn't want to push the market too far in any one direction when it's really everyone is waiting to see how it starts to pan out, what the movers and shakers are going to be in the market, how are the buyers, how the shippers going to react, and then how the Polish response from Russia and the G7. So there's a lot of moving parts, and everyone is still kind of waiting and seeing.
Oh, well, absolutely. And let's not forget that we still have a lot of economic data coming in. 14 December is going to be the US Fed meeting as well. So, well, yes, it does not really end here. But Sushant, what's your sense on the prices then? And how would you look at crude oil, natural gas? What's your outlook for 2023?
Well, I mean, if you look at the oil prices today, they're currently weighed down by the expectation of a slower demand growth. But what we think is, as Russia overcomes logistical challenge to reach new markets, to have its crude reach new markets, we do expect Russia's crude production to come down in the next few months, which could tighten the market and lead to higher prices. And apart from this crude import ban, we also have the product import ban coming in February. And with the diesel market already tight globally, we expect that also to support the crude oil prices in Q1 next year. So on an average, we could see prices breaching $95 per barrel for Brent in Q1 next year. But obviously, the outlook for oil demand and OPEC policy will be key things to watch here. Now, as we head towards after Q1 next year, we expect prices to soften. As I was saying earlier, the market is expected to be more balanced for next year, given where the supply and the demand growth are.
All right. So markets will balance out next year, but $95 per barrel is an average price that Sushant is looking at. Paul, what's your sense? What kind of pricing are you working with for natural gas and crude oil?
For the oil side, our analysts are looking at sort of $85 a barrel towards and heading up a bit towards 90 through next year. So a little bit of tightening going on, but not too much, because I think demand is still a huge way on the market. It's going to be a real economic weakness next year across the board. And yes, China may alleviate that, but at the same time, there doesn't seem to be much wiggle room for this global economic slowdown, given that we've got high inflation and interest rates have to rise to try and combat that inflation. Higher commodity prices, which, let's face it, gas and oil are very high. Even at these prices, oil is still quite high. That continues to feed into the inflationary scenario, and the central banks around the world are having to battle. And if you raise interest rates, we know that continues to put the brakes on growth and the global economy. So you don't really see much wiggle room for the demand side, and that is going to be a continued drag on that bullishness we're seeing from the supply side.
Clearly. All right. So $85 to $90 to $95 a barrel of range is where the crude oil prices can be trading next year as well. From various reports that I have read, nobody really has mentioned the three-digit number of $100 for the next year. Not yet, not until now. Markets, of course, still awaiting on what Russia can do to, in sense of, retaliate. But thank you so much, Sushant and Paul, for joining us today and giving us your sense on crude prices and, of course, the fundamentals as well. On that note, it's time for a break, but don't go anywhere, because this discussion continues and we will put full focus on what the India impact can be. And we are joined by Mr. R.S. Pandey on the other side. Welcome back. Joining us on the show now is former Petroleum Secretary, Mr. R.S. Pandey. Mr. Pandey, thank you so much for joining us. And even as whatever is happening in the international markets, the whole fact that nearly 80% of the global countries actually import crude, and India's dependence clearly is high. Within the Asian markets, our growth is on the higher side as well. Even as we import from Russia at a much discounted price, with what's happening, how do you see that impact coming in for India?
The way things stand as on today, this oil price cap will not have much difficulty for India.
Okay.
After the war, as the situation developed, India started getting more and more from Russia. Now this price cap at $60 minus the insurance and shipping costs, well, Russia is not getting more than this at the present moment. So there is no difficulty. And even if it goes above 60, then as we understand, Russia has arranged logistics and they will deliver. India has made it very clear that they are not going to be subjected to this price cap.
Right.
So is the case with China. So as the situation stands today, there is no difficulty.
Mr. Pandey, even as we have seen crude prices come off, even as India is getting crude at a discounted rate, but the fact being that the rupee has been depreciating and with these price caps, do you think India will have to pay more when it comes to insurance and free trades?
Well, as we understand, as of now, Russia has been delivering through Western insurance, etc. And if the price cap is at 60 and the delivered price comes to less than that, then the price cap does not take effect. The sanctions don't take effect. If it goes beyond this, then there is a question of sanctions. But then Russia has also arranged alternative logistics. So that shouldn't really make much of a difference because the global demand situation is such that the price is not going to go much high. China, as it stands, the global economy in Europe and US, as things stand today, there doesn't seem to be any difficulty. But should China's economy recover, COVID situation improves, and then the international price goes up, then there could be some issues, but one doesn't think that will be the scenario. But additionally, those who impose the price cap, they have also said that every 2 months they are going to relook at it. They revise it upwards or downwards. So nobody really wants the crude supply to stop. China and India have made it very clear they are not going to be part of the price cap because that suits Russia. If they become part of the price cap and the price goes beyond this level, then Russia might disrupt supplies even at a cost to it, economic cost to it. So today there is no difficulty, but if the price goes up and if the revision is not consistent with Russia's liking, then there could be serious issues. And I think all concerned will like to avoid that scenario. That is how they didn't cap the price below 60. There were demands within Europe that let it be at 30, let it be at 40, but those who imposed finally, they kept it at level of 60, which suits almost everyone in the current situation. And OPEC is also watching, and they have made it very clear that as on now, they will not revise it. They will not say whether they will increase the supply or decrease the supply, but they are on wait and watch, and they are seeing how the situation develops.
Clearly. Mr. Pandey, as we were discussing before the break as well with our global guests, that 2022 clearly has been a difficult year. We've seen a huge volatility and so many things unfolding. And as we enter into the new year, it's not that things are changing because the uncertainty is just about continue here. How have you seen the Indian demand in 2022? What's your sense, even at these higher prices, even at skyrocketing fuel and aviation prices, we still have seen demand continue to grow?
Well, India somehow, although we are in a free pricing regime, the prices did not revise for the last several months, except one time when the excise duty was reduced. So it has not really been a free pricing situation, given the level of inflation, given the requirements of elections. Government of India did not touch the prices, and the companies were apparently taking instructions from the government. But now the price level has come down, and there is certainly a need for revising the prices downwards, retail prices. Now let's see how it goes, because companies have incurred a lot of losses. If you see their balance sheet for the past 6 months, they are in a really loss situation. About 20,000 crore is the combined loss of the 3 oil marketing companies. So unless the level of taxation, the excise duty comes down, unless the VAT rates come down in various states, well, it is difficult for Government of India to revise the price downwards.
Clearly. So even as in the international markets, India may stand tall in sense of getting a discounted crude, but for the Indian markets itself, the thing really seems to be getting slightly difficult or serious as it might be. Mr. Pandey, as always, thank you so much for joining us, sir, with your sense on the energy and the Indian aspect there. But with that, it's time for a wrap on this edition of Commodity Champion. News continues on CNBC TV 18. Stay tuned.